And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Thursday edition of The Real Investment Show, of course. Today is the day, second best day of the week, day before Friday, of course. It's also inflation day. So today we're going to be getting that inflation print. Comes out at 7:30 this morning, of course. This is what markets are all kind of anticipating right now as to, well, what's that number going to be? I mean, we're now watching inflation like we've never watched it before. Now it's like every month it's like, oh my God, what's the print? The print! What's the print of inflation? Well, it's going to, it's expected to be about 7.3% on an annualized basis. There is some expectation that actually could come weaker than that number. In our daily market commentary, which is up on our website now, the Fed member, Raphael Bostic, came out yesterday, implied kind of the same thing. And this is something that we've talked about here for a while, is that inflation, as we measure it, is likely peaking. And I want to be clear about that, because this is an important thing that we're going to be dealing with now for the rest of this year and really potentially for a while. Inflation will come down. And that's just a function of how we measure inflation, because we measure it on a year-over-year basis. So today we'll get a monthly print, right? So we'll see inflation is up, I'm just picking a number, 0.3. And last month was 0.4. Well, inflation's still going up, but the rate of change on a month-over-month basis is starting to come down, because it's just not rising as fast. So let me put this into an easy kind of way to understand this. Gas prices. We all deal with gas prices every day, right? So we go to the gas pump, we fill up tanks. I went and filled up my truck the other day, and it was $3.34 a gallon, right? So that's the number. Well, so when I filled up, that price is obviously higher than it was a year ago, so that's why we have inflation. Now, a year from now, if the price of gasoline is $3.34, the rate of inflation is zero, right? The price hasn't gone up. Now, it's still expensive. It's still costing me a lot more than it cost me when President Trump was in office, as an example, right? Almost twice as much, right? I'm paying almost twice as much for gas as I was during the last administration. However, the rate of change of that inflation won't change. So here's the important part about this when it comes to economic growth. We measure economic growth by the amount of consumption that we do in the economy. So just because inflation becomes disinflationary, the rate of inflation comes down, it doesn't mean that prices have actually come down. Prices can just stay elevated and we will get disinflation. But consumers don't necessarily have any more money to spend. They're spending more money at the pump to buy gasoline. They're spending more money on food prices. So more of the stuff that eats up their daily disposable income is still there. So even though wages are coming up, wages haven't come up as fast as inflation, as price increases have. So I don't have, and Americans don't have, as much discretionary income to go buy other stuff. And this is why we're starting to see credit card debt go up. We're starting to see more the amount of credit card debt rise, because consumers are having to revert back now that they don't have these $1,400 checks, $900 checks, extended unemployment benefits, child tax credits, all that money that we were injecting into the economy allowed people to pay off some credit, not use their credit card because they had some extra money coming in every month. Well, now that's going away. So now they're having to go back to their credit cards to help make ends meet. And this is going to be one of the impacts that we talk about. First quarter GDP growth right now, estimated by the Atlanta Fed on their real-time tracker, was 0.1%. Now that number came up because of the employment report that we had for January. That number came up, but we're still sub 1% growth for the first quarter of 2022. So economic growth is already slowing, not surprising because of all this extra liquidity coming out of the markets. But again, when we start talking about inflation, the rate of inflation can come down and will come down. We will see a disinflationary bent to a lot of these numbers just because of the rate of change on a year-over-year basis. But that doesn't mean that prices have gotten any cheaper. So that's the kind of the interesting takeaway from all of this. And that's, of course, is going to start to weigh on corporate profit margins. We're already starting to see corporate profit margins begin to contract, something we talked about last year. We'll see earnings for corporations begin to guide down here. And again, earnings expectations for stocks are still very high here, but over the course of the next several months, we'll start to see those earnings estimates being tailored back as the reality of slower economic growth is really starting to set into the economy. Now, yesterday, we had a nice rally in the markets, particularly in tech stocks. Now, tech stocks do better in a disinflationary environment than other inflationary type companies, right? So energy was weak yesterday. Technology was strong yesterday because of this idea of a disinflation type bet. And right after Raphael Bostic talked about weaker inflation, we really saw kind of a surge in the markets. We had a nice open yesterday, rallied up to a high. We closed up over 1% yesterday. Unfortunately, while we did get back above that 20-day moving average kind of resistance level we've been fighting with for the last couple of weeks, we're actually still below the 50-day and really just where we were last week. So we haven't gone anywhere over the last week. This morning, we'll see what markets say. Now, if we do get this more kind of disinflationary bias in the numbers this morning, we could see a follow-through rally. Again, if markets can get above this 50-day moving average, that does give us a shot back at all-time highs. So that would certainly be encouraging for the bulls at this point. But again, we've got to get above that resistance level. Markets are getting overbought here in the short term. So, kind of that gas in the tank we've talked about before, that deep oversold condition we had back in January, we've used all that gas up in the tank. So there's kind of running on fumes at this point, running on empty, as Jackson Brown would say. But there is a good shot here. If the inflationary print comes in weaker than expected, could see some follow through here with the markets. Starting to see more and more stocks now moving above their 200-day moving average. That's actually a very bullish indicator for the markets. So as we begin to move here over the next couple of weeks, we could see a push higher here heading into the Fed meeting if the idea starts to manifest itself that the Fed may begin to back off some of their more hawkish stance on hiking rates, being aggressive. If we do see some of this kind of more talk from, people like Raphael Bostic talking about, well, we're going to have maybe a little bit less inflation than we thought. Inflation seems to be kind of peaking here. That's kind of early talk. We might see the Fed back off the gas a bit. That would help give markets a lift. Now, again, don't mistake what I'm saying here. We're still moving into a tightening environment. It doesn't look like at this point that the Fed is going to back off raising rates and tapering their balance sheet. That's still going to weigh on stocks as we get further into the year. It doesn't necessarily mean we're going to have a crash in the markets, but it does suggest that returns may be a lot more muted than we saw last year. So this is as a lot of things to consider here, and I know there's a lot of data points that we're talking about: economic growth, inflation, earnings, but this is all going to kind of start to gel as we start to head towards that March meeting. And once we start to see what the Fed is actually going to kind of lay out as a game plan of how fast they're going to taper their balance sheet, what type of how aggressive are they going to be about hiking rates, that's going to give us a much better idea about how to navigate the markets this year. More importantly, where to allocate money to. And something that we'll talk about this morning with Michael Lebowitz, he'll be joining me right after the break, is this idea of buying value, because you've got to be careful here. We've been reviewing quite a few portfolios. Not as much value in value as you think there is. And we'll talk about that when we come back from the break. I'm Real Science Roberts for this morning's edition of the Real Investment Show. Get by the website, realinvestmentadvice.com. Be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. Realinvestmentadvice.com. Click on the insurance tab.
Do you know what you don't know when hiring and retaining quality employees? Compensation is more than just wages. It's personal time off, the vacation days, healthcare benefits, a 401k. Do you know what's important to them? Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Let us show you how to make the most of an affordable, effective package that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And good morning. Welcome to the show. And of course, Thursday, as I said earlier, and getting the second best day of the week underway. Michael Lebowitz joining me this morning to talk a little bit about why there's no value in value, or at least you've got to be very careful about it, and the implications of that for the market. But before we get there, I just wanted to, kind of finish up our conversation on inflation here and let Mike weigh in as well, because he's the inflationista in the group. Mike, good morning. How are you?
Good. Inflationista. I like it. My wife will be so proud of me.
I'm going to get, that's the next t-shirt you're going to get. Hashtag inflationista.
Brent, you got my address?
Oh, yeah.
We do.
Oh, yeah. We get on speed dial.
So, all right, Mike, you kind of heard what we're talking about a little bit at the open here. Raphael Bostic talking about maybe a little bit weaker print in inflation. It does, and again, I think we have to be very clear about this. And this is, this has been the argument over inflation for the last 2 decades, really, when Ben Bernanke was talking about, inflation's coming down, and Alan Greenspan as well. Of course, one of the great comments was that, the price of an Apple iPad is coming down, and the reporter at the time said, yeah, but you can't eat an iPad. So, there's always been a big differential between what the government reports as inflation and what the average American experiences as inflation. And what we're talking about here is government inflation. Raphael Bostic talking about, hey, we could potentially see maybe a little weaker print today, but that doesn't mean that prices got cheaper.
Right. There's a lot of math there, but you know what? You can't measure inflation. I can measure my inflation. Mm-hmm. I could go through my credit card statements, my bank statements, and look at every transaction and see what it would have cost a year prior. Mm-hmm. But my payments and your payments are very different. Right. Not only are we buying different things, you live in Texas, I live in Maryland, right? The guy across the street from me is very different, right? They do different things than we do. He spends money on different things. So the whole idea of calculating one aggregate inflation number is kind of ridiculous, right? What the number does do, however, is give you a trend, right? We know inflation is running hot, right? Whether it's 7% or 10% for me and 4% for you, we both know that our inflation numbers have gone up, unless we've bought nothing for the last year, right? So that's point number one. The other thing to think about with the Fed, when you talk about the Fed and inflation, is context. For the last 10 years prior to the pandemic, the Fed has been begging for more inflation. You go back and look at almost every Fed statement, and it's like, we just want a little more inflation. We want to get up to 2%. And it's so funny because it was, about a year ago, the Fed adapted a new inflation targeting system. So prior to about a year ago, they said, our objective is 2% inflation a year. That's what we want, right? And that's what we're going to try to achieve.
And we'll let it run hot. And we'll let it run hot for a while.
Well, that was what they said. We're going to average 2% over multiple years.
Right.
So, when they did this about a year ago, they said, okay, well, we ran 1.7, 1.6, 1.7, 2%. So our average for 4 years has been 1.7. So we could run 3% for a year, and our average over those 4 or 5 years would be 2%.
Surprise.
Right? Surprise. Now inflation is running, even over 5-year periods, probably 3 or 4%.
Right.
And all of a sudden, they want to get rid of inflation, right? They had no control. They kind of admitted, Lance, that they had no control to push up inflation. Right, they were begging for just a few tenths more inflation, and they couldn't do it. Right, we went through periods where they were easing aggressively. We went through periods where they were tightening policy, and through all those machinations, they couldn't get inflation to where they wanted to be.
Right, but
now we're to believe that they're a puppet over the inflationista, and they can move it as they please.
Yeah, no, the hubris of the Fed is pretty wild. But it didn't take a rocket science to figure out that if you inject 1.9 trillion, $2 trillion, another 900 trillion, 900 billion, whatever, in just policy after policy where you're sending checks to households, it wasn't rocket science that you were going to get a spike in inflation, that demand, and particularly at a time that you had shut down the economy, people weren't working, we weren't producing. So just basic economics, the Fed should have said, hey, if we do this, we're going to get a sharp spike in inflation. So they should have been hiking rates last year and saying, look, we're about to get a big surge in temporary inflation because we shut down the economy. We've got all this liquidity going to households. We're going to hike rates here just to try to counterbalance that. But, they just kept their foot on the gas for 2020, 2021, zero rates, $120 billion a month in QE. And now they're all sitting back going, oh, my gosh, now what do we do about it? And so now we're going to reverse all this policy just at the time that all that liquidity surge is coming out of the markets and supply is coming back online. If you take a look at recent manufacturing reports, et cetera, inventory builds are coming up. So you're about to have a reversal of supply and demand and get a bigger disinflationary push in the economy. Now the Fed's going to be back on their heels going, okay, now hold on a second. Now we can't raise rates because now we've got disinflation. So, I mean, it's, I think they've got themselves in a pretty tough spot here trying to manipulate inflation without destroying the economy in the same process.
And look, Lance, let's just say we're wrong on inflation. Inflation's, we're here a year from now and inflation's running 8%.
Right.
The Fed's really got trouble then. Right, because then they're aggressively tightening policy, raising rates, cutting QE, and what if they find out that they don't really have much of an effect on inflation?
Right.
What if inflation is more psychological at this point? People are so scared of paying more tomorrow than today, they buy everything today. We're still seeing it with toilet paper, with some basic staples. People are still hoarding this stuff.
Yeah. Well, no, it's true until you get to the point that you hike rates enough to, basically
kill the economy.
Yeah, and that's really what this will come down to, is that, as always, and the Fed has a long history of this, is they'll hike rates until they break something in the economy. And the question is it 1%? Is it 1.5%? Where is that number? Well, we don't know, but it's not very far away from where we are.
Right, but we do know that number is less than it was in 2019.
Right.
And that number in 2019 is less than it was in 2014. And that number was less than it was in 2006, right? It's been a declining threshold, so to speak, where higher rates, because there's more debt to GDP. It's not that there's more debt. It's that there's more debt to GDP. So if you think about it from your own personal balance sheet, there's more debt and the same amount of income. And that ratio has been rising of debt to income, meaning that you can't afford the debt. The only way to afford it is with lower interest rates. And that's been basically the MO for this country for 20, 30 years. But interest rates have gotten so low that the benefit is negligible of zero rates, right? We've seen rates down here before. We've seen mortgage rates, below 3%. So, looking forward, you have to get mortgage rates, to 1.5%, 1%, to force people to refi and to lower their cost of debt. At the same time, if you bring mortgage rates up to 4 or 5%, you do a lot of damage to the housing market, right? If you bring auto loans up to 4 or 5%, cars aren't going to sell as much. And look, at the end of the day, the Treasury is sitting on over $30 trillion of debt, which they're refinancing constantly. Now, a big chunk of it doesn't refinance this year or next year, but every new, all the new debt plus whatever is maturing gets refinanced at, say, 4 or 5%. That interest expense over a couple of years starts rising rapidly and making your debt problem even worse.
Yeah. It's interesting too. Governments are trying to figure out other ways to deal with the inflationary pressures. I thought it was interesting that the Bank of England has asked the public not to ask for pay raises to help quell inflation, right? Because wages are a big inflationary push, right? So if people have to pay more in wages, they've got to raise prices to compensate for higher wages. And I thought it was interesting, the Bank of England's solution to solving the inflation was to ask people who have basically been struggling now for the last 2 years, don't ask for a pay raise.
But did you see so Biden is apparently thinking about getting rid of the federal excise tax on gasoline.
Right.
Which is kind of funny if you kind of really think about it, right? That tax has been there, and it just pays, it helps pay for the, it eliminates some of the deficits. So regardless of whatever you think of that tax, he's basically thinking about getting rid of a tax, meaning that they're going to subsidize, right? Everyone to buy oil, right? It's just another subsidization, easy for me to say.
But if you reduce, his goal is though, if you take away the excise tax, the price per gallon of gasoline will go down at the pump, and that's what's really impacting. Look, inflation is killing his poll ratings right now. Going into the election, you got midterms coming up very shortly. His 39% approval right now.
Right.
That's not healthy. This is a bad, again, kind of a short-sighted solution to trying to bring down gas prices at the pump. That excise tax is what goes to a lot of other spending that we do, and to your point, is going to cut the amount of revenue the government has coming in at a time when they don't have that enough revenue to cover spending.
Political. Right. His goal is political, and now they're going to be lacking that revenue. They're going to have to borrow more.
Well, look,
putting even more dependency on interest rates.
Exactly. But again, this is the overall problem. We've talked about this before, but it takes right now more than 100% of tax revenues just to cover mandatory spending and interest on the debt. So everything that we spend, it's interesting. There was a kind of a big hoopla on Capitol Hill. It's like, okay, we're working bipartisan here. We've got some bipartisan legislation coming down the pipeline. Great. This is your job. To raise the debt ceiling again, right? Because we have another debt ceiling, potential government shutdown coming up next month. So they've got to raise the debt ceiling again to do this. Don't worry about passing a budget. We haven't done that since Obama was in office. But let's just keep these continuing resolutions going and keep our spending out of control. That's going to really solve our debt problem long term. All right, quick break. We're going to come back. Like I said, value. Value has underperformed growth for one of the longest periods on record in the financial markets. The problem is that there's no value in value. And we'll talk about that when we come back from the break and how to navigate that trick. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What What boomers need to know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
And now, another page from the Real Investment Advisor's Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So, if you're moving from California, New York too, love you, welcome you. Come be a Texan. It's a great place to live. Wonderful people here. Very friendly. Just don't vote the same way.
Remember,
that's all we ask.
You're refugees, not missionaries.
Exactly.
The Real Investment Show podcast. Same show, your schedule.
Anyway, is the bottom end. That's the...
at realinvestmentadvice.com.
Because I think it is in California. So.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn. Thursday, February 10th. Register now at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I want to start out this segment. We're going to be talking about the lack of value and value. This is something that Mike wrote an article about yesterday. It's on our website, and something that has been a real challenge, in portfolio management this year is trying to balance a portfolio between growth and value. Value has underperformed growth now for one of the largest stretches on record. In fact, the value growth ratio is at one of the lowest levels ever on record as well. The problem, though, is that when we take a look at value, companies like Hershey's, Coca-Cola, McDonald's, Proctor Gamble, these stocks that are traditionally considered a value really aren't a value. I want to read to you something that we talked about this on the show before, but price to sales. This is one of the measures that, kind of is a great way to look at a company value-wise, because it's difficult to manipulate what happens at the top end of the income statement. So sales is what happens at the top, then you have all your expenses, all your accounting manipulations and gimmicks and everything else that goes on, and then you get your earnings per share at the bottom, and that is not always a great representation of what's actually going on in the company. But look at sales. Sales tells you a lot. Scott Manili was the CEO of Sun Micro back in 2000, and he said this to a press conference at the time. It was actually a Bloomberg interview. He says, at 10 times revenue, right? So 10 times, so price to sales, 10x. At 10 times sales, to give you a 10-year payback, I must pay you 100% of revenues or sales, for 10 straight years as dividends. That assumes I can get that by shareholders. It also assumes I have zero cost of goods sold, which is very hard to do with a computer company. That assumes that zero expenses, which is hard with 39,000 employees. That assumes I pay no taxes, which is very hard. And that expects you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero R&D for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at 10 times price to sales? Now, mind you, this was in 1999. 2 years later, Sun Micro was on the verge of bankruptcy. The point about this is that value is very important. So at 10 times price to sales, would you like to buy Sun Micro? Well, looking back in history, obviously not. But take a look at Hershey's, Coca-Cola. They're trading at 5, 6, 7 times price to sales now, and these are companies that are very slow growers in terms of revenue and earnings. So at 2 times price, just to give you some context to start with, okay, at 2 times price to sales, just 2, a company has to grow their revenue at 20% every year. They have to have a 20% sales growth every year just to maintain a price to sales ratio of 2. So at 5, 6, 7 times price to sales, how fast does a company have to grow their revenue to maintain their current valuation? This is really kind of the point that Mike got to yesterday. So Mike, when we start taking a look at these value stocks, what's causing this problem? I mean, it would seem like value in this, especially over the last year, where we saw stocks like Peloton that were just exploding in value over that last couple of years. That there would be a lot of value in some of these companies, but it's not. What's causing that?
I think the one of the biggest causes of there not being value in value is this wave of passive investing. So when we passive invest, we're buying indexes, right? And whether that index is a value index or the S&P index or a growth index, or there's a million of them, you're buying every underlying stock, regardless of whether it has a price to sales of 1 or 10. You are buying a share of every stock. Mm-hmm. So when you buy the S&P, you're buying Proctor Gamble, you're buying Hershey's, you're buying all those companies Lance mentioned. Right? Regardless, there is no discerning between valuations. So every time you can kind of think of this as the investing population as active investors and passive investors, right? And what we've seen over the course of the last 10 years is that there's a much reduced number of active investors and much more passive investors. And that has essentially broken the valuation system. What used to happen is when a value stock was too valuable, meaning its price to earnings, price to sales, whatever metrics you use was too low, active investors would get in there and buy it. They would push the valuation up to a normal range or above normal, at which point they would sell. Mm-hmm. And they would essentially regulate valuations to some degree. Now you have people that are just throwing a dart at a dartboard and buying everything on that dartboard.
Right.
And the purpose, this article is kind of a two-story article. I should have broken it into 2 stories. But the bottom line is the passive versus active side of the story, and why, we highlight Proctor Gamble, why a company like Proctor Gamble can trade at a PE of close to 30, despite having much slower earnings and revenue growth than the S&P, which trades at, what's its current PE, 23, 24, 22, whatever it is. Why would you value more for Procter Gamble than the market, right? When it's growing at a slower rate than the market. And it's Procter Gamble. They don't have the next iPad coming. They don't have the next big thing coming. We know what Procter Gamble is, for better or worse, right?
Yeah, toilet paper.
They have a million products. They're great products, great company, but it is what it is, right?
Yep.
And even if they get a new brand of toilet paper, it is so small compared to their book of business.
Yeah, but people are going to hoard it, though.
Oh, of course. So the purpose, the first part, the second part of the article is kind of talk about this passive and how value is almost meaningless now because of what passive funds and passive strategies have done to the market. And Procter Gamble, again, trades at a P of 29. We believe it's overvalued versus historical valuation ratios by nearly 50%.
Right.
We looked at it on a price of sales basis, similar thing. We looked at what Zacks had to say about it. I think they said it was 40% overvalued. Mm-hmm. The problem is, and we own Procter Gamble, right? We have a 2% stake in it in our portfolios. Mm-hmm. It is part of the S&P 500. It is going up, and passive investors are ruling the day. So even us as discerning are we still value investors, Lance? We like to think we are, but this isn't a value investing market.
Yeah, exactly.
Right?
But
you've seen.
Yeah, but there's another problem here too that outside of the passive indexing, there are people that buy individual stocks like Procter & Gamble, like Coke, like McDonald's. And I think that, and the other part of that story is the Fed, which, by the Fed keeping interest rates at zero artificially for over a decade now, flooding markets with liquidity, suppressing, interest rates on all types of fixed income instruments to levels where you can't, if I go buy a 10-year treasury, I can't keep up with the rate of inflation. There used to be a time I could buy treasuries and make 5 or 6% pre-2008 on my money. I could just buy a 10-year treasury and I could make a decent return on my money. But, the Fed has now forced all these people to go chase yield. And, you go into the markets and you're trying to find a stock that's paying a 1.5 or a 2% yield. And you're having to way overpay for the value of that company just to try to get some form of yield on your money. And and that yield chase has been one of the other big factors, I think, in driving the valuations of these what we traditionally call a value company, to such overvalued levels. And I think that's really kind of the key definition here, Mike, also, is that we're talking about companies that are typically deemed to be value companies, right? So if we look at the markets and we break it into two halves, we say, okay, Procter & Gamble, that's a value stock, and Apple is a growth stock. And we throw them into buckets. It doesn't mean that the S&P is sitting there going, okay, Procter & Gamble is undervalued, so now it's in the value bucket. And if you even look at value funds, like value-based ETFs or value-based mutual funds, those valuations are very high.
Well, that's what we did.
Yeah.
We looked at a large Vanguard fund, which is probably in a lot of your 401k plans or some variation of it, whether it's Vanguard or Fidelity or whoever it may be. And Procter Gamble, of course, is in the top, one of the top holdings of that. So we looked at the top 10 holdings, and all we did was we looked at 4 valuations. And we said, how do they compare versus the S&P, and how do they compare against the lowest decile of the S&P 500? So we took those 50 or so stocks that have the lowest PEs, the lowest price to book, the lowest price to sales, lowest price to forward earnings, and said, how does it compare? Only one of the 10 had one of those 4 metrics that was in the lowest decile. That was Berkshire Hathaway. Mm-hmm. And a lot of them, a good chunk of them, weren't even at the median of the S&P 500. So look, these may be value companies. They're great companies. If you look at this list, it's Berkshire Hathaway, which I would actually say is a value stock. Mm-hmm. But it's Exxon, it's Procter Gamble, it's J&J, Pfizer, Abbott, Bank America, JP Morgan, a couple others. Exxon, I think, was in there. Value companies, but they're not value stocks. And there's a huge difference there, Lance.
And I think there's an important message here for investors that I think is critical, is that if and when we get into another market downturn, typically you could go into value and kind of be shielded from the downturn a bit, because those were undervalued companies. Money would tend to rotate into those undervalued companies during the middle of a bear market. And that would give you some protection. Doesn't necessarily mean your portfolio would go up in value, but it may not go down as much. That may not be the case in the next bear market, particularly once if we do trigger the point people start to liquidate en masse these passive ETF funds. There may not be a lot of places to hide in the markets outside of actual fixed income within the equity classes itself. And we'll touch on that when we come back from the break about potentially what causes the next downturn and what it might mean for investors. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you leaving thousands in Social Security money on the table? Prepare to properly claim your Social Security at our next virtual Lunch and Learn. What boomers need to know about Social Security. Your claiming choices now can affect your loved ones later. Join Richard Rosso and Danny Ratliff for our next RIA Advisors virtual Lunch and Learn, Thursday, February 10th at noon. What boomers need to know about Social Security. Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. Realinvestmentadvice.com. Click on the insurance tab.
What worries you about your money? Enhance your financial success with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how you can achieve. Create your own personal financial vision for the next decade with MyBlocks, our free tool at RIAadvisors.com. Click on the Client Portal tab, RIAadvisors.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. It is, of course, 6:47 as we get ready to wrap the Thursday edition of the Real Investment Show up for you. Don't forget today, if you have not signed up yet, we have a virtual event at noon today. It is What Baby Boomers Need to Know About Social Security. It's with Danny Ratliff and Richard Rosso talking about everything you need to know about Social Security, how to claim, when to claim, what to claim. Making a mistake on your Social Security can cost you hundreds of thousands of dollars, literally, in benefits, and cost you more in taxes, a whole variety of other issues. And they're going to cover all that with you. It's absolutely free, of course. Just go to our website, and there's a big banner right on the front page. Just click there to register. It's at noon today, so pack your lunch and come online and hang out. Seating is limited. It's an online event, so sign up now. But
no masks required.
But no mask required, unless you're
watching with someone.
Yes, then wear your mask, sure. Or you're robbing someone, one of the two. So anyway, but go online now, realinvestmentadvice.com, and click on the big banner there. Again, that's at noon today. Love to have you there. So, and again, they're going to talk about everything you need to know about Social Security. So, just for the break, talked about this issue that during the next downturn in the markets, when it occurs, and this will eventually happen at some point. Now, whether it's this, there's a lot of talk right now from a variety of different corners of the kind of the financial media is like, oh, we're about to have the biggest crash ever, and Robert Kiyosaki, the biggest bear market ever is coming. Maybe not. Who knows? We'll navigate that when we get there. But there's a lot of concern over it with the Fed hiking rates and potentially tapering their balance sheet. That is typically turned into at least decent market routes, if nonetheless. And as we talked about for the break, a lot of people are maybe hiding in value, thinking they've got some relative safety there, but that may not be the case. And this is going to be kind of an important point in terms of managing risk in a portfolio. Some of the traditional places to shield your portfolio against a market decline may not provide that protective benefit that you may be expecting. Mike, your thoughts?
Yeah, I think what investors are going to have to look at is how well is the company represented in passive funds and ETFs and mutual funds. The problem being, and we a week ago or so, maybe a few days ago, whatever it was, we sold in our sector model. We sold a little bit of a discretionary ETF. We still hold it, but we trimmed it down a little bit. When we sold that ETF, we effectively sold Amazon, which is about a quarter of the index, but we sold every single underlying stock in that index indirectly. Right. So if you go to the bottom of that index, there's definitely a few value stocks in there, large value stocks, but value stocks. Those got sold. Right. Now you take a company that is not in these indexes. It's held by definition by active investors, right? It's not in any passive funds. Only active investors hold it. So we take our ABC ticker company, our hypothetical company. It's got a PE of 5, a price to sales of 1, a PEG ratio that's very low. It's everything we want in a company, but it's a great value. We're not selling that. It's like owning a great business at a very cheap price. We're active. We don't have to sell it, right? We may be forced to make sales because we're losing money in other places. We may have to sell it, but we're not indiscriminately selling it. We're making a decision. We want to sell ABC because we need money, because we don't think it's going to rise because of this, that, and the other. When we and every other passive, we're not a passive investor, but when every passive investor or anyone in passive products goes to sell, they're selling across the board. And that's the problem here. Now the flip side of that, Lance, is that investors are buying value in name only, right? They're buying funds that have the word value in it. The XYZ value fund, the value ETF, the S&P large cap value fund, right? They think it has value. And as we show in the article, there's not much value in the value fund. But right, if the perception is that the market's going to be weak this year, and passive investors are not going to give up on passive investing, they're just going to, take a more conservative approach, move from growth to value, move from tech to value, move from whatever it is to value. They're going to buy the word value, right? So some of these companies like Proctor Gamble, like those, like what's in that fund that I discussed earlier, could do well for a little while. However, if there's net selling in a market, so they may sell growth a lot more, but they're also selling value, then it's indiscriminately going through all those funds and selling. Right. And that's kind of the what I would call is the part 2 risk. If we're really, if the market's really going to sell off for a year or two, and passive investing is going to lose its steam and active investors will become more active, then what we're going to see is probably initially a rotation to value in name, not those small, those small companies not many people have heard of that are trading at PEs of 4, PEs of 6, single digit PEs. And then that's when those companies, and this is exactly what we saw in 2000, right? Lance, you were talking about Sun Microsystems. Right. You were a moron if you didn't own Sun Microsystems in 1999, right? Right. That was the Apple, the Microsoft, the Tesla, you couldn't not own it, right? And the best thing you could have done for yourself was be the first one out the door, but essentially not own it, right? And at the same time, you have these value stocks. And back then, passive investing isn't nearly what it is today. Value stocks did okay, 2000 to 2003. They eked out a gain over that period while the S&P was down, 50%, the NASDAQ was down 80+%. So, depending on how this plays out, if and the Fed's in play, and look, we may be going to new highs, passive may become even more powerful. So all these passive stocks underlying these passive indexes may continue to do great. We may just see a rotation within passive to value. So the quote unquote value stocks may do great, or we get a washout, and that's where true value, small caps, stocks that aren't in the major indices are very poorly represented. That's their turn to shine. And, but this all depends on what environment we're going into. And there's nothing that says we're not going to hit new highs over and over again this year, just like last year. And there's nothing that says we can't drop 30, 40. You wrote a paper about the market dropping 50%, right? So you can't just say, okay, I'm going into value and that's it, because value's been a loser for the last 10 years.
And look, and during a decline, the best place to be may be bonds. Right now, the sentiment we talked about before, sentiment on bonds is the most negative on record right now, other than back in 2017, just before we got into the 2018 debacle. But we often talk a lot about stocks, and this is all that the market focuses on, the media focuses on, is like, stocks, growth to value. And again, during a declining market, you'll be losing money on both sides of the ledger, maybe not as much in value, but you're still going to be losing money. And you might actually be making money in bonds, because that's where money will rotate to for ultimate safety. And it just depends on how big that decline actually is. And again, I wrote this paper on Monday talking about a 50% correction. We're not calling for a 50% correction in the markets. That's not the point of the article. The point of the article is the markets, because of the Fed actions over the last 2 years, have deviated the market so far from its long-term growth trend going all the way back to 1900 that it would take a 50% correction just to retest that growth trend. That wouldn't even be a bear market. That would just be a correction with an ongoing bull market. And that's really just to show you how deviated these markets have become. And if you think you're safe, and this is really the point that Mike's making, if you think you're safe trying to hide in value, if we get into a more protracted bear market, if we do get a reversion back to the growth trend line, which always happens, ever since 1900, you regularly retest that exponential growth trend line. If you get a retest of that growth trend line, it's not going to matter what equity class you're in. You're going to get hammered. Bonds will do well. So you need to make sure you also have an allocation towards fixed income in your portfolio as well, because that truly will shield you during a bigger decline.
Right. And Lance, we were talking about Proctor Gamble earlier. For it to get back to its price to earnings, where it traded from 2019 to 2012 and probably well before that, or around that area, it would have to drop almost 40, 50% to be at fair value. Right. We're not saying it's on sale. We're not saying it's cheap. Just to get back to where it has been historically on a what you're paying for earnings basis.
Right. And that's a problem though across the entire market. And again, this is a function, really honestly, at the end of the day, yes, it's a function of passive investing, but it's a function of also the Fed keeping interest rates too low for too long, putting too much liquidity into the markets, fueling these asset market increases that we've had, then laying on top of that trillions of dollars worth of fiscal stimulus, monetary stimulus on top of it. So, you've just got, we've just created this epic bubble in markets over the last 2 years that truly is unsustainable. The question is only now what cracks it, and that's the thing that we never know, right? What's going to be the catalyst or the trigger that starts to bring markets back in line with some form of rational reality? And then, of course, how big is that correction actually going to be? Is it 10%? Probably not. Is it 20? Maybe getting into the ballpark. We don't know. But we'll have to figure that out. But it's at least something to be paying attention to, particularly if you have a lot of money invested in the markets, is that there is risk. And we're not saying that the markets are going to crash tomorrow. We're not saying any of that. All we're trying to say is that there's a risk because of this kind of irrational exuberance that has developed in the markets over the last 2 years. And investors are kind of looking at value and saying, oh, well, that's a value stock. It must be value. You've got to really look beyond what just something is classified and look to see if you really actually do own value or not. That wraps up the show for the day. Get by the website. Michael's article on value is on the website right now. It's a really good piece talking about this value growth proposition. It's on the website now, realinvestmentadvice.com. Of course, send us your questions, comments, emails. Let us know what we can do for you. Always happy to help you out. And don't forget, today at noon is our Social Security webinar talking all about what you need to know about Social Security to make sure you don't make mistakes claiming Social Security at the wrong time or doing it the wrong way. That's at noon today, realinvestmentadvice.com.